Good morning. Thank you for listening to our prepared remarks for the Conagra Brands first quarter fiscal 2026 earnings. At 9:30 Eastern this morning, we'll hold a live, separate question and answer session on today's results, which you can access via webcast on our investor relations website. Our press release, presentation materials, and a transcript of these prepared remarks are also available there. I'm joined this morning by Sean Connolly, our CEO, and Dave Marberger, our CFO. We'll be making some forward-looking statements today, and while we're making those statements in good faith based on current information, we don't have any guarantee about the results we'll achieve. Descriptions of our risk factors are included in our filings with the SEC. We'll also be discussing some non-GAAP financial measures. Please see the earnings release and presentation materials for GAAP to non-GAAP reconciliations and information on our comparability items, both of which can be found in the investor relations section of our website. I'll now turn the call over to Sean.
Thanks, Matthew, and good morning, everyone. Thank you for joining us today for our first quarter fiscal 26 earnings call. Let's begin on slide 4. Our first quarter performance demonstrated that we're on track with our priorities across our portfolio. Our strengthened top line and improved market share reflect the resilience of our brands and the work we've done to restore service levels. We executed well against our frozen, snacking, and staples strategies. Our supply chain delivered on key objectives, and we successfully completed our Chef Boyardee and frozen seafood divestitures, using those proceeds to reduce net debt. As we look to the balance of the year, we expect inflationary pressure and weak consumer sentiment to persist. We remain focused on strong execution and operating with agility to drive sustainable success, including maintaining a disciplined approach to capital allocation. Amidst this evolving landscape, we are reaffirming our fiscal 26 full-year guidance. Today, I'll walk you through our Q1 performance and provide an update on our outlook for the remainder of fiscal 26 as we continue navigating a dynamic operating environment. Let me start by unpacking our Q1 consumption performance. As you've heard us discuss in prior quarters, we've been strategically investing behind our brands to drive volume recovery in the face of a challenging consumer environment. This slide demonstrates the continued effectiveness of our investment playbook. Q1 consumption trends in both volume and dollars improved meaningfully over Q4 fiscal 25 levels as we recovered from supply chain issues impacting our frozen meals containing chicken and frozen vegetable businesses. The service recovery efforts we've been focused on are clearly translating into improved in-market performance. On slide 8, you'll see 44% of our portfolio held or gained volume share in Q1, an improvement relative to Q4 fiscal 25. We're getting products back on shelves, and consumers are responding. Turning to our frozen domain on slide 9, our frozen portfolio delivered solid progress. Volumes improved 3.2 points in Q1 compared to our Q4 fiscal 25 growth rate, aided by our service recovery. We're particularly pleased with our share gains across key categories, with frozen vegetables, frozen meals, and frozen prepared chicken all up in the quarter. Part of what's enabled this frozen performance is our restoration of quality merchandising activity. Last quarter in Q4, our volume sold on promotion was down 25% compared to the prior year. However, we made significant progress closing that gap this quarter in Q1, trailing the prior year by only 10%. With our supply issues now behind us, there is still some room to go as we approach more normal levels of brand support. And encouragingly, we continue to see a rational environment in terms of depth of discount, which has remained consistent for Conagra since fiscal 24. Moving to our snacking domain on slide 11, our snacks business performed in line with expectations. We saw strong volume in our strategic protein snacks categories, with meat snacks up 4% and seeds up 2%. And as expected, we experienced discrete impacts from merchandising timing shifts in salty snacks and pricing-related elasticity in sweet treats, specifically Angie's Boom Chickapop declined 19% due to a shift in promotional timing to Q2, and Duncan Hines saw a volume decline of 8% due to elasticities following our inflation-driven cocoa pricing actions. When you look at the total snacks picture on slide 12, even with our pricing actions and promotional timing shifts, our volume performance slightly exceeded the categories in which we participate. In addition, our dollar growth was strong at +2.2% versus +0.5% for our categories, reflecting the benefit of our strategic pricing actions and favorable mix. Turning to slide 13, in our staples portfolio, Hebrew National had a strong recovery as we lapped our out-of-stocks in the year-ago period. Additionally, we are gaining volume share in categories such as chili, tomatoes, and refrigerated whipped toppings. We continue to see value-seeking behavior from consumers that has impacted this domain, but we remain focused on managing our margin levers, including the steel inflation-driven pricing that we expect to implement late in Q2. Moving to slide 14, our supply chain performance was a key success story in Q1. We were highly focused on our service metrics and were extremely pleased with the results. We achieved 98% service levels, ensuring our products are on shelves and available for our consumers. In addition, we delivered strong productivity gains in excess of 5% of cost of goods sold. We've made good progress in both our core productivity programs as well as our ability to navigate the volatile tariff environment, which Dave will discuss shortly. And last, we remain on track with our supply chain modernization efforts, including the baked chicken project that will be completed in Q2. Turning to slide 15, we successfully completed our Chef Boyardee, Van de Kamp's, and Mrs. Paul's divestitures in Q1. We used the proceeds to reduce net debt by more than $400 million in the quarter. Now let me shift to our outlook for the remainder of the year. Looking ahead, we continue to navigate a challenging environment as we're still dealing with persistent inflation and tariffs, both of which have drifted higher than our original expectations. Our previous outlook for core inflation was approximately 4%, but that has moved slightly higher primarily due to increased costs in animal proteins such as beef, pork, and turkey. On tariffs, while we still expect our gross exposure to be approximately 3% of cost of goods sold, changes to country-specific tariff rates have nudged our estimate higher. Our larger exposures to steel, aluminum, and China-related tariffs are unchanged. Combined, our total inflation was previously approximately 7%, but has now nudged higher to be in the low 7% range. Against that backdrop, consumer sentiment remains weak, and we still see value-seeking behavior. We continue to focus on a balanced approach to capital allocation. Slide 18 shows we're investing in the business with approximately $450 million in CapEx planned for this year, in line with our initial expectations. We're also returning capital to shareholders as we expect to maintain our $1.40 annual dividend rate. As always, we continue to look for ways to sharpen and strengthen our portfolio, as proven by our recent divestitures. And, as I mentioned, we reduced net debt, a key focus area, by over $400 million in Q1. Turning to slide 19, our strategic priorities for the year remain unchanged. We're focused on growing frozen and snacks. We're increasing investment in supply chain resiliency. We're implementing targeted pricing, largely in our canned products, but also on select sweet treats within our snacks portfolio, where we're dealing with sustained cocoa inflation. And we're highly focused on delivering strong productivity and cash flow. Overall, we're encouraged by our performance in Q1 and the improvement we've seen in our top line. Today, we're reaffirming our fiscal 26 guidance outlined here on slide 20. For fiscal 26, we continue to expect organic net sales growth of -1% to +1%, adjusted operating margin of approximately 11% to 11.5%, and adjusted EPS of $1.70 to $1.85. With that, let me turn it over to Dave for more financial details.
Thanks, Sean, and good morning, everyone. Slide 22 shows our financial results for key metrics in the quarter. Conagra's organic net sales were $2.6 billion, a 0.6% decline versus the prior year. Adjusted gross margin of 24.4% and adjusted operating margin of 11.8% were both down versus the prior year, but slightly better than our initial expectations, which I'll unpack shortly. Adjusted earnings per share were 39 cents, down 14 cents versus year ago. Slide 23 shows our first quarter net sales bridge. Total Conagra organic net sales decreased 0.6% over the previous year, with volumes down 1.2% and price mix up 0.6%, partially driven by trade expense favorability that we expect to reverse in Q2 and favorable product mix. Foreign exchange was a 10 basis point headwind, and the divestitures of our India joint venture, Chef Boyardee, and frozen seafood businesses together had a 510 basis point impact. Slide 24 shows the composition of net sales by segment. In grocery and snacks, we delivered net sales of $1.1 billion, representing a 1% decline in organic net sales versus the prior year, with lower volumes being partially offset by higher price mix. Our refrigerated and frozen segment also delivered $1.1 billion in net sales, with organic net sales up 0.2% versus the prior year, as higher volumes were partially offset by lower price mix. We saw strong volume improvement following a return to normalized supply, as well as a benefit from lapping the prior year's constraints on our Hebrew National business. In our international segment, organic net sales declined 3.5% versus the prior year, as elasticity-related volume declines more than offset price increases in each of our regions. Organic net sales in our food service segment returned to growth in the first quarter, increasing 0.2% over the prior year. Volumes improved versus Q4, benefiting from stabilizing commercial traffic trends in addition to favorable price mix. Slide 25 shows that adjusted operating margin declined 244 basis points over the previous year to 11.8%. Price mix was a 20 basis point headwind driven by unfavorable product mix, partially offset by select price increases across our segments and the favorable trade expense timing that I previously mentioned. Inflation remained elevated in Q1 at approximately 7%, inclusive of both core inflation and gross tariff costs. Proteins remain the largest headwind as we continue to see double-digit inflation in areas such as beef, pork, chicken, turkey, and eggs. Our productivity was strong in Q1, as Sean highlighted earlier. The combination of core productivity and tariff mitigation came in at over 5%. Tariff mitigation was favorable to expectations, with inventory positions allowing us to offset more tariff costs than projected. Partially offsetting this was unfavorable operating leverage from lower internal production volumes. We remain on track to complete our baked chicken facility modernization in Q2, with the benefits of insourcing production being realized largely in the second half. Adjusted SG&A, which includes advertising and promotion expense, was 50 basis points unfavorable to year ago, primarily due to higher incentive compensation expense and slightly higher A&P spend, in line with our expectations. Our segment adjusted operating profit and margin results are summarized on slide 26. Grocery and snacks adjusted operating margin declined 97 basis points, as favorable price mix was more than offset by higher inflation and adjusted SG&A, inclusive of A&P. Refrigerated and frozen adjusted operating margin declined 402 basis points, primarily driven by elevated protein inflation, as well as by transitory sourcing and absorption headwinds related to our supply chain modernization projects. Despite the elevated input cost pressure we're facing, our priority of investing margin to drive volume in frozen remains unchanged. International adjusted operating margin improved 394 basis points, driven by price increases and favorable FX comparisons to year ago. And finally, food service adjusted operating margin declined 269 basis points as price increases and productivity were more than offset by higher inflation and unfavorable mix. The adjusted EPS bridge for the first quarter is shown on slide 27. Adjusted EPS was 39 cents in the quarter compared to 53 cents a year ago, driven by lower adjusted operating profit, a higher adjusted tax rate, and reduced profit from divested businesses, which more than offset higher pension income, lower interest expense, and favorable foreign exchange rates. Key balance sheet and cash flow metrics are shown on slide 28. During the first quarter, we utilized our divestiture proceeds to reduce net debt. Compared to the year-ago period, we've reduced net debt by nearly $1.1 billion and ended the quarter with net leverage at 3.55 times, a slight improvement versus both year ago and last quarter. We remain committed to a balanced capital allocation as we target long-term leverage of 3 times. Capital expenditures totaled $147 million, and dividends paid were $167 million for the quarter, both largely in line with the prior year. As expected in Q1, free cash flow was impacted by our seasonal working capital build, in addition to rebuilding inventory from our recent supply constraints. We also repurchased $15 million of shares during the quarter to offset dilution from our share-based incentive compensation plans. As Sean mentioned, we are reaffirming our fiscal 26 guidance for key metrics shown here on slide 29. We continue to expect organic net sales growth in the range of -1% to +1%, adjusted operating margin of approximately 11 to 11.5%, and adjusted EPS in the range of $1.70 to $1.85 per share. Slide 30 provides a bit more color on our expectations for the second quarter and the full year. For the second quarter, we expect organic net sales to decline low single digits, driven by recent consumption trends and a shift in trade expense to Q2, which was formerly expected to impact Q1. From a profit perspective, we were able to mitigate a large portion of our tariff costs in Q1 than we initially projected. However, in Q2, we expect our net tariff costs to be higher than Q1 as we have largely utilized pre-tariff inventory. This, in addition to the trade timing mentioned earlier, is expected to result in Q2 operating margin moderately below our full-year range. For the full year, we continue to expect organic net sales growth in the second half as we wrap supply constraints in our frozen business from last year and our pricing actions take hold, partially offset by pricing elasticity impacts. As discussed, we now expect full-year inflation in the low 7% range. This is slightly higher than our original projection of approximately 7%, with the modest increase to be largely offset by higher productivity and tariff mitigation, inclusive of the amount mitigated in Q1. We continue to expect A&P at approximately 2.5% of sales and adjusted SG&A excluding A&P at approximately 10% of sales for the year, both unchanged versus our prior expectations. And last, we expect our fiscal 26 cash tax payments to be favorable to our prior estimates by approximately $75 million due to recently passed legislation. And finally, turning to slide 31, you can see our additional fiscal 26 guidance metrics. We now expect our full-year tax rate to be approximately 24%, up from 23% due to the higher rate we saw in Q1, and interest expense to be approximately $390 million, down from our prior estimate of $400 million, following the $1 billion of new bonds issued in July. Our expectations for each of the other line items shown remain unchanged. That concludes our prepared remarks.
Good morning, everyone, and welcome to the Conagra Brands Q1 Fiscal Year 2026 Earnings Q&A conference call. All participants will be in a listen-only mode. Should you need assistance, please signal a conference specialist by pressing the star key followed by 0. After today's presentation, there will be an opportunity to ask questions. To ask a question, you may press star and then 1. To withdraw your questions, you may press star and 2. Please note today's event is being recorded. At this time, I'd like to turn the floor over to Matthew Neisius, Head of Investor Relations. Please go ahead.
Good morning, everyone, and thank you for joining us. Once again, I'm joined this morning by Sean Connolly, our CEO, and Dave Marberger, our CFO. We may be making some forward-looking statements and discussing non-GAAP financial measures during this session. Please see our earnings release, prepared remarks, presentation materials, and filings with the SEC, which can be found in the Investor Relations section of our website for more information, including descriptions of our risk factors, GAAP to non-GAAP reconciliations, and information on our comparability items. I'll now ask the operator to introduce the first question.
And ladies and gentlemen, at this time, once again, if you would like to ask a question, please press star and 1. Our first question today comes from Andrew Lazar from Barclays. Please go ahead with your question.
Great. Thanks so much. Sean, Conagra expects to return to positive organic sales growth in the fiscal second half, but also mentioned recent consumption trends in pointing to a low single-digit decline expected in the second quarter. What's driving the fiscal second half inflection, or is it really just easy year-ago comps? And do recent consumption trends that you mentioned sort of give you any pause, particularly in light of the planned tactical pricing actions that you're taking? And I guess, to what do you attribute the recent consumption weakness?
All right. Good morning, Andrew. Let me tackle that in reverse order. First, I wouldn't overly read into any recent consumption trend data. To the degree you saw any softening at the end of Q1, that was tied primarily to the two things I mentioned in my prepared remarks, which is the shift of a major Angie's Boom Chicka Pop promotional event to Q2 and the initial planned elasticity effect of the inflation-justified pricing that we took on Duncan Hines due to cocoa costs. So that's kind of the Q1 concept. This quarter in Q2, some of our major frozen events are planned about a month or so later than a year ago, based on our supply ramp-up. So pretty consistent with what we would expect in the full year, just a little bit of a shift in timing. So not much else to really discuss there. As for the basis of our expectations for further sales progress in the second half, it will be a combination of volume momentum on frozen, where we wrapped last year's supply constraints, plus continued volume momentum on growing businesses like protein snacks. And then you have to also add what I'll call dollar momentum on inflationary businesses where we're taking price. That combination of factors reflects the horses for courses plan that we built. And what I mean by that is we are investing to drive volume in frozen and snacks while maximizing cash via inflation-justified pricing in staples.
Got it. Thank you for that. And then fiscal first quarter came in ahead of expectations. Fiscal second quarter was moderated a bit in terms of your outlook. Net, do you see fiscal first half as potentially coming in a bit better than originally planned? And then, Dave, how much was the benefit from trade expense timing to organic sales growth in the quarter? Thanks so much.
Yeah, Andrew. So taking the last part first, it was about 50 basis points of benefit in Q1, the trade timing, and then that will flip to Q2. So 50 basis points in terms of sales. So in terms of first half, I would say, given the kind of the flip in timing of that, given the fact that Q1 we had some benefit in inventory where we delayed some of the tariff costs, and now they're going to be coming in Q2. I would say generally we're still on track with our original plan for the first half. There's kind of different pieces. We talked about in our guidance, we're a little favorable in interest expense, but our tax rate's a bit higher. So there's obviously some puts and takes, but I think we're pretty much on our first half plan.
Yeah, and I'd say, Andrew, that what I was looking for this quarter really were two things. Number one, can we get the service issues behind us? And getting to 98% check. I'm feeling good about that. And second, once we did that and could start to resume our merchandising activities and rolling out our innovation, are we getting the consumer takeaway, and are we seeing inflection on key businesses? And check, we saw that. So, the consumer is certainly not out of the woods yet. We're still seeing value-seeking behavior. We're still having to deal with inflation and tariffs. But, after a quarter, I think we're feeling good about the setup for the balance of the year.
Great. Thanks so much.
Our next question comes from Peter Galbo from Bank of America. Please go ahead with your question.
Hi, good morning. Thanks for the questions. Sean and Dave, I just wanted to maybe touch on the updated core inflation outlook that you gave. I know you talked about some of the moving pieces within kind of the animal proteins, but maybe you can just remind us, kind of how you're bought for the remainder of the year on some of those items. Are you kind of locked in now for the rest of the year? Just given that some of these, cuts are very volatile and have moved, particularly chicken over the past month has maybe moved more favorably. So just want to understand the flex in that inflation guide as we get in the back half.
Yeah. So Peter, our original guidance, our overall inflation was approximately 7%. That's split 4% kind of core inflation, and then 3% gross tariffs. Then we had mitigation, obviously, on tariffs of about 1 to 1.5% on that. And then we have our productivity, which helps us offset our core inflation. As we've gone through this quarter, we're seeing more pressure on the core inflation. There's been a little bit of movement on the tariffs, but generally that's immaterial. So the 3% gross tariffs we estimated at the beginning of the year are about the same. The increase in the overall inflation for the year is really coming from the core inflation, and that's really driven by the animal proteins. And so particularly beef, pork, turkey, and then to some extent eggs relative to our original forecast. To your question about kind of where we are, from a kind of overall coverage perspective, for Q2, we're about 85% covered. Certain commodities are fully covered, but then the animal proteins, which has been a pressure point, that's more spot market overall. We do take positions and freeze them, so we have capability to add coverage through freezing proteins, but generally that's more market and spot based. And so about 85% covered Q2, and then for the full year, 60 to 65% coverage overall. But again, those proteins were exposed. If there's additional inflation or if the inflation moderates, we'll see a benefit from that.
Great. Thanks for that, Dave. Very, very helpful. I wanted to pivot maybe to the balance sheet and the cash flow. Dave, I know you called out that there would be some debt pay down in the quarter. I've gotten a few questions this morning just on the cash flow generation in the quarter. It was a bit maybe lighter than expectations and some of the inventory build. So maybe you can unpack both the debt pay down, how we should think about that in 2Q and the remainder of the year, and then just anything around kind of inventory build that happened in the quarter. Thanks very much.
Sure. So let me kind of start from the top. When we gave our guidance, we had forecasted that we would pay down $700 million in debt for fiscal 26. That's from both the proceeds from the divestitures as well as $100 million from cash flow from operations to pay down debt. So we're still on track with that. Actually, we included in our materials that we're going to have additional favorability from the tax legislation. We are estimating that at $75 million. So we haven't built that into our specific free cash flow forecast yet, but that's clearly going to be a benefit. As it relates to Q1, we have, and this is just solely timing. We built more inventory in the first quarter because remember, we were coming off supply disruptions, and so we had to get back to service levels. So that was a priority. We built our inventory. So our normal seasonal build affects Q1. Then we leaned in to make sure we had the right safety stocks on the areas where we had disruptions. And so you normally will see that in Q1. It's a little bit more. So our inventory on hand, we have more days on hand, but that's been planned. That's timing. And we still feel comfortable about our full year forecast as it relates to inventory. So I would say we are on track. Q1's the normal build. And in the first quarter, our net debt is down about a little over $400 million versus where we finished at the end of fiscal 25. And as we said in the comments, on a rolling 12, we've reduced our net debt by $1.1 billion. So feel really good about cash flow generation, both where we are and how we're forecasting it for fiscal 26.
Just one other piece of perspective on that inventory build. Several of the peers in center store grocery have really struggled in the last year to generate consumer pull against their brands, even when investing. We have not had that problem. So you may recall we had 6 or 7 quarters of straight line, top line improvement as we invested in the pursuit of volume last year, and we returned to growth in Q2. So we've got clear evidence that the brands and the innovation are working for consumers. But we ran into the supply interruption, and we had to pull a lot of our merchandising. So now that we've got service levels back, armed with that confidence that we can generate consumer pull because of these products, we are absolutely convinced having inventory in place so we don't fall out of stock again and fail to keep up with consumer demand, particularly going into holiday season, is absolutely the right thing to do.
Awesome. Thanks, guys.
Thank you.
Our next question comes from Tom Palmer from JP Morgan. Please go ahead with your question. Mr. Palmer, is it possible your phone is on mute? And just to confirm, the speaker room, are you able to hear me?
Yes. We can hear you.
Okay.
It looks like we've got Palmer number 2 in the queue. So why don't we go there and we'll come back to Tom in a bit.
All right. Our next question comes from David Palmer from Evercore ISI. Sir, please go ahead with your question.
Okay. Thank you. Good morning. Frozen entrees, obviously it's been a great long-term category for Conagra. Just looking at the recent data, and I know there's reasons for this, maybe some overhangs from some of the past supply chain stuff, but wondering, what is your state of the union with that category? It looks like you guys are losing share and the category is declining. For years you guys were driving the majority of growth in a category that was oftentimes growing at least a little bit. So wonder what your frozen outlook is, frozen entree in particular outlook is through the rest of the year, and I have a quick follow-up.
Sure. All right, David. Our outlook is positive. The simple way to think about frozen meals is the category goes as Conagra goes. That's been the rule for the last 7 or so years. When we didn't innovate back in the day, the category didn't grow. When we committed to innovating frozen, the category grew steadily for a long, long time. So, including, by the way, in our Q2 last year, I think our frozen business was up in the ballpark of 3%. So we're coming off of a back half of last year where we had major service interruptions in that business. We walked away from major merchandising, and that hands our merchandising to competitors who then get in the customer plans for a period of time while we're working to get service levels back. That contributed, obviously, to us being a share donator, which is the first time that's happened in years and years and years. But that's obviously a temporary phenomenon tied to our supply interruption. So what you're seeing now is our innovation is rolling into the marketplace. Our service levels are back to 98%, and we're getting kind of back in the queue on these major events and feel extremely bullish about it. We've got some absolutely fantastic innovations that we rolled out last year that were interrupted. We're rolling out new ones this year, and they're already off to a particularly strong start. I will draw your attention to the new Dolly Parton frozen meals and frozen desserts that are new in the marketplace and performing extremely well. And what's encouraging about that as well is they're not only performing well, that's a premium price product. So that's good mix for us too. So, I have tremendous confidence in our frozen business. To win in frozen, you've got to have scale and you've got to have an innovation machine. And, we've got the best in the business. So we're looking forward to continued momentum on that business as we go through the year and wrap some of the weak spots in the last year, second half.
Yeah, thank you for that. And just a very general big picture question. You're going to have those easier comparisons in the second half of the year, and you're going to be more on your front foot. I'm wondering, what are some, I don't know if there's exact metrics you can share, but what are the things you're going to be looking for in the second half that will really tell you that you get back to balanced sales and profit growth in fiscal 27, if that is, the goal here is to get back to an on algo in 27? What would kind of let you know you're there? Not, clearly growing against some of these comparisons may not be enough for that. So, perhaps give us a sense of what you think would be, quote, good enough in the second half to show us you're really on track again. Thanks.
David, you once had a good piece of wisdom for me. You said your hero businesses got to be heroes, meaning frozen and snacks need to grow. And I think that is well said. I think, for this company, frozen and snacks are clear growth categories. It represents about 70% of our retail business. We've had tremendous momentum on both of those businesses leading up to the supply challenges we had last year. And by the time we exit this year, I want to see real momentum and inflection on those businesses. We've already got it within the key strategic snacks businesses. For example, Slim Jim right now is tracking really well. C-Store is coming back. That's very encouraging. And our new innovation on Slim Jim, which is our new Buffalo Wild Wings, Buffalo Chicken Slim Jim, is performing really well out of the gates. That's a very positive sign. On frozen, it's all about getting back in the queue on merchandising events with customers and then making sure that this innovation that we work so hard to build performs, and so far it looks good. So, those businesses with a positive trajectory as we move through the year, I think is a very, very positive sign for next year when we've got some of these margin clawback opportunities in front of us. So that'll be a combination of a good-looking top line and an improving gross margin line as well, and I'm looking forward to that.
Thank you very much.
Our next question comes from Brian Adams from UBS. Please go ahead with your question.
Hey, morning, guys. Thanks for the question. Maybe just first a quick housekeeping one following up on David's question there. So 1Q volume performance for refrigerated and frozen came in a lot better than I think maybe scanner trends would have suggested. And I think in the prepared remarks, you said volumes for frozen itself were up like 3% or so. Was there any elevated shipments in the 1Q as you were finishing up restoring supply at shelf, or is this pretty consistent with the consumption trends that you were seeing?
Hey, Brian, the 3% number, I was referring to Q2 last year when frozen was back growing strongly in Q2. So, shipments were a little bit ahead in the quarter, which is pretty typical at a time when you've been out of stock and you're kind of replenishing. I wouldn't overthink this, because if you look at our company on kind of a rolling 4-quarter basis, shipments and consumption are almost always equal. So for us, it doesn't really amount to much. So I wouldn't overthink that piece. Anything to add to that?
The only thing I would say, just if you're just purely looking shipments to consumption within the quarter for R&F, that Hebrew, obviously, because of prior year, shipments were really strong. So there's a little bit of benefit, shipments versus consumption related to Hebrew within Q1 for R&F.
Okay, awesome. Thanks. Yeah, not my best reading comprehension, I guess, there. On the margin clawback opportunities that you just actually spoke to, can you kind of just run through those high level for us as we think about 27? Because some of the stuff, some of the costs you've had this year, like tariffs, that's not necessarily something you can assume goes away. But then I also know you have some work in process on the chicken, and then I'm not really sure the puts and takes on SG&A. But do you mind just running through those, Sean, as you see them today?
Sure, absolutely. Yeah, I'll tick off 5 things that I mentioned last quarter that remain intact. It starts with productivity. So in fiscal 26 this year, between core productivity and tariff mitigation, that number is just over 5%, which is very strong. And by the way, Q1 came in right at above that level, which is, a super strong quarter. So, that will continue. Supply chain team is doing a nice job. Second, at some point, we're going to get inflation relief. Somebody mentioned proteins a little bit ago, hopefully back closer to our typical 2%. If you look back 100 years as we have, anytime we've had these kind of runaway inflation cycles like this, there's always been relief on the other side of the hill. So at some point that will happen. We obviously can't call exactly when. Third, the advancement of our supply chain resiliency investments, including the chicken plants will enable us to repatriate some of that outsourced production going forward at lower costs. Fourth, we are taking pricing in certain categories. So after you get past the initial lag of inflation hits and you wait 90 days or so to get pricing in, you start to get the benefit of that. And then fifth, I mentioned last quarter, we were kicking off an ambitious initiative to re-engineer our core work processes, leveraging technology, including AI. We have kicked that work off to accelerate growth and lower costs. We'll have more to report on that going forward, but that's an exciting possibility. So between those actions and our ongoing efforts to reshape the portfolio for faster growth and better margins, we do expect good margin expansion following fiscal 26.
Okay. Really helpful. Thanks, Sean. Thanks, Dave. We'll pass it on.
Thank you.
Our next question comes from Robert Moskow from TD Cowen. Please go ahead with your question.
Hi, thanks. I have a phasing question about 2Q volume, Dave and Sean. I'm just looking at comparisons versus year ago on volume, and it would appear that the volume growth comp would get tougher in 2Q compared to 1Q because of the Hebrew comparison and also because you had a lot of frozen vegetable volume in 2Q. So should I assume that volume growth is or volume declines are similar in 2Q as in 1Q because of those comps, or is the merchandising activity enough to provide some sequential improvement in volume?
Yeah, Rob, this is Dave. We have obviously a ton of brands, and so there's a lot of moving pieces, a lot of dynamics on merchandising. Generally speaking, the volume that we had in Q1 should be similar in Q2. And, when you net it all together for total company.
In terms of growth. Okay.
Yeah, in terms of volume.
Thank you very much.
Year-on-year growth.
Yeah. Thanks a lot.
Yeah, and just for perspective, Rob, on the year-to-go basis, we had strong investment profile in merchandising last year. We had to pull back on some of that in the second half. We have a very strong investment in merchandising behind this innovation for the year-to-go period as well. And, as I mentioned, some of those innovations which just are getting going now are already performing quite well. So we're looking forward to that. And you saw in the promotion chart I shared in the prepared remarks that while we've had some of the merchandising restored in Q1, there is room to go as we move through the back half of the full year.
Got it. Thanks, Sean.
Our next question comes from Megan Clapp from Morgan Stanley. Please go ahead with your question.
Hi, thanks. Good morning. I wanted to start with maybe a follow-up, Sean, to Andrew's second question at the beginning, just around how the quarter played out and how you're tracking so far. You made a comment last quarter that you viewed the fiscal 26 guide as prudent given the operating environment. And you talked about a lot of encouraging things that you saw in 1Q. At the same time, consumer sentiment's weak. You talked about value-seeking behavior. Cost inflation's a bit higher. So just putting all those puts and takes together, I guess when you think about the fiscal 26 guide today, you reiterated it. Would you still characterize it as prudent, and maybe where is the guide in your minds, the most conservative? Thank you.
Well, I think it remains prudent. As I mentioned to somebody this morning, that the two things I was really looking for in this quarter is we got to get service back, right? Because we had a lot of momentum. That momentum was, very materially interrupted in the back half of last year because of service. And we've got confidence if we get service back, we will get the consumer takeaway. And so we got service back to 98%. That's good. And the fact that the innovation is off to as strong a start this year, actually stronger than what we had last year. So we had a very strong innovation performance last year in terms of not only customer acceptance, but the velocity of that innovation right up to the point where we pulled our merchandising, particularly in frozen. And so it's good to see the innovation out of gates this year performing even higher level in terms of units per store per week, velocities, things like that. So that's a positive. And between that and the plans we've got calendared out for the balance of the year, I think the outlook is prudent, and we're pretty optimistic about building that momentum that I talked about with Dave Palmer a few minutes ago as we move through the year. Specifically, this is a horses for courses annual operating plan that we built. There are some businesses where we've planned out the year to invest to drive volume growth, specifically frozen and snacks. We're seeing movement in the right direction there. I expect to see more of that as we get to the back half. There are other businesses that we are facing more acute inflation because of things like tin plate tariffs, where we're taking more inflation-justified pricing. There, it's about dollars. So between the volume plans that we've got and the dollar plans that we've got, I think it comes together and puts us in a prudent position.
Okay, great. Thanks. And that's a good segue to my follow-up, which is, as you think about implementing tariff-related pricing, which I think you said will come on late in the second quarter, have your views on elasticity and the expected elasticity changed at all, just given you're still seeing some value-seeking behavior with the consumer? And if we just think bigger picture around the macro, the consumer is going to be seeing a lot of, it seems like, inflation-driven pricing start to roll in around the same time. Thank you.
Good question. We track elasticities weekly, and we've kind of built in a historical elasticity expectation in categories as we built the plan. Specifically, what we've seen is within our categories, Conagra's average elasticity is a bit better than our competitors across channels. And then further, at a company level, if you look at just total pricing versus total volume change, you'll also see that our elasticity has been a bit better than most peers over the past year. So I don't feel like we are assuming anything heroic in terms of elasticities going forward, even in the face of the pricing actions that we've got.
Awesome. Thank you.
Thank you.
Our next question comes from Max Gumport from BNP Paribas. Please go ahead with your question.
Hey, thanks for the question. Sean, I'm curious for an update on the value-seeking behavior that you're still seeing. It's been a few years now, so I'm just wondering how you see this cycle playing out and how you're positioning Conagra to come out of this cycle in a better place. Thanks very much.
Yeah, I mean, I think you're probably hearing the same thing from just about everybody in consumer packaged goods on this. It is kind of this barbell economy where you've got higher income consumers that are showing more resiliency and they're still spending. You've got lower income consumers across different age groups that are being more discerning. They are absolutely doing what they've got to do to kind of maximize their household balance sheet. So we've got to deal with that. But clearly there is more value-seeking behavior, that is evident in the lower income group. So our job is to give those consumers the value they're seeking. And with the portfolio scope that we have, there are a lot of great value choices. And that's a big part of why, sales are improving and so are shares. So going forward, we'll continue to put that value lens on our innovation and marketing effort because it matters. And, if you weren't seeing this kind of behavior, I think if you look at our innovation slate over the last 10 years, you've probably seen it skew toward more premiumized products. But when you have a large cohort of consumers that are value-oriented, you take a different lens around your innovation for both price pack architecture and the kinds of innovation that you want to deliver. Why? Because the benefit of superior relative value is a benefit that's going to move the sales line. And so you should imagine that we not only have a good slate of great value offerings already out there, but it does inform our innovation pipeline going forward to make sure that we've got products that are very provocative, not because of maybe an ultra premium benefit, but because of a value benefit.
Great. And then as a follow-up, it was nice to see service levels get back to 98%, and then that enabling a recovery to some degree in quality merchandising and improved volume share performance as well. As we look to the remainder of the year, is there any color or guardrails you could provide on how you expect your promotional levels and your volume share performance to progress from here? Thanks very much.
Yeah, I'll point to some data that I shared last quarter, which is if you look across the group, specifically the near-in kind of center store peers, what you've seen is that promotional levels in terms of percent of total volume sold on promotion has kind of migrated back to just about pre-COVID levels. It's uncanny. It's almost pre-COVID levels company by company. And so we're a little lower than that because we're still recovering from supply interruption, but moving back toward that. But I have not seen promotional levels go above that kind of pre-COVID norm. So that's a positive sign, I think. And then the second metric we track is kind of depth of discount. Are we seeing this more broad-based desire to have a return to volume growth now leading to deeper discounts? And the answer is no, we've not seen that. And that's been that way for several quarters running. And I think that's positive because I think what it shows is that it's a rational environment. Everybody is to some degree investing margin in the service of volume. And, I think that kind of keeps your feet on the ground here. So it's been a rational environment, and I think there's room for us to do more in terms of merch. We moved, back in the right direction, but we're not back to where we were. But obviously do it in a very rational way. So that's our intent.
And our next question comes from Scott Marks from Jefferies. Please go ahead with your question.
Hey, good morning, Sean, Dave. Thanks so much for taking our questions. First thing I wanted to ask about, coming back to some of the recovery of the supply chain disruption from earlier this year. You've spoken about, obviously, recovery in your own service levels, rebuilding of your own inventories as well. Wondering how you're seeing it from the retailer side in terms of their inventory levels relative to where they were prior to the disruption on frozen vegetables and some of the chicken products. Thanks.
Yeah, good question, Scott. It's probably not a lot of drama in the answer, though. We're not seeing anything particularly noteworthy. So I would say pretty typical and, nothing that I can report that would really be of any real news. Anything you'd add to that, Dave?
Yeah, no, when we use the term service levels, there's very specific metrics in terms of where they are with their levels and inventory. And so, customers are kind of back where they need to be, generally speaking.
Got it. Thanks for that. And then follow-up question just on some of the chicken facility modernizations. I know you made the comment that you're still expecting the baked chicken facility to be completed in Q2. I think you're still working through a fried chicken modernization that's expected a little bit later. How should we be thinking about maybe cadence of recovery of the margin, let's say? I know you spoke about some benefits in H2, but just trying to gauge, how we should be thinking about the restoration of margin from that perspective. Thanks.
Sure. Well, the baked chicken project that's the one we kind of started with, so that's farther along. And then the fried chicken is kind of a newer development because the demand for fried chicken has just exploded in the last couple of years, and we had tremendous success last year with our banquet mega fillets. So that's an investment that will go on a little bit longer. And in the meantime, it'll be an investment that moves some of that production out of house, which has kind of a double whammy in that we lose the absorption of not producing it ourselves, and we pay a tolling fee for that. But that'll correct as we go forward as well. So baked comes on first in terms of the benefit, and fried will follow that. I mean, the good news here is we sell a lot of healthy meals in frozen, and these days, the ones that contain protein are the ones that, not surprisingly, people are really buying. Unfortunately, it's also been the inflationary part of the basket. So we've got, that's where we had a decision to make in terms of what are we after short term, volume or margin. And we fundamentally believe that the best thing for the future cash flows of our frozen business is to keep that consumer pull strong and keep our market share strong. And that's why we're investing some margin in the short term to really get that volume cranking.
Got it. We'll pass it on. Thanks very much.
Thank you.
And our next question comes from Tom Palmer from JP Morgan. Please go ahead with your question.
Hey, thank you. Is round two here? You can hear me?
We got you, Tom.
All right, a third Palmer on the call. I wanted to just ask on the timing of inflation and kind of how it plays out over the course of the year. I think from the materials, it seems like to start off the year, maybe it was a little bit favorable to that kind of 7% plus. Is 2Q, just given what we're seeing with protein, maybe heightened, or just I guess any help on kind of the cadence over the next 3 quarters as you see it today?
Yeah, Tom, it's Dave. The Q1 the real favorability there was for tariffs and timing on tariffs. The core inflation was kind of where we thought it would be actually a tad bit higher. So when you kind of look at Q2 through Q4 and you look at overall inflation, it's pretty consistent from a percentage perspective to the full year guide of slightly above 7%. There's no material change in the year-on-year percentage of the inflation.
Okay. Understood. Thank you for that. And then, Sean, I just wanted to kind of clarify, I guess, one item, and I know it's been asked about already a little bit, but it seems like you are seeing benefits from promotional activity, but at the same time, as you have kind of taken some pricing initially, maybe you noted a little bit lower elasticity than you might see in the past. I mean, look, I get some of this is maybe we're talking about different products where these two are applied, but I guess in the current environment, are you guys kind of baking in that one of these two sides shifts a little bit to converge?
I think what we're baking in, Tom, is that as we roll out our innovation and our marketing support, including our advertising and our major merchandising events click, we're going to have the kind of consumer pull that we've seen in the past. So that's on the more volume-oriented businesses. And then on the more dollar-oriented businesses, I think we've baked in a historically accurate elasticity level. Usually that's around a -1. And we have not seen any elasticities to suggest that is an overly optimistic point of view at all. So I think in total, the outlook for both sides of the horses for courses concept is that it's prudent. And I expect, good consumer response in the areas where we're investing to drive volume on frozen and snacks as the year progresses. And I expect there will be an elasticity effect on canned goods and some other things that we're taking price on, but they should be fairly predictable effects consistent with history.
Thank you for that.
And ladies and gentlemen, at this time, we'll conclude today's question and answer session. I'd like to turn the floor back over to Matthew Neisius for closing remarks.
Thank you, Jamie, and thank you all for joining us today. Please reach out to Investor Relations with any additional questions. Have a great day.
And ladies and gentlemen, with that, we'll conclude today's conference call and presentation. We do thank you for joining. You may now disconnect your line.